joint meeting of the two boards, the two retirement boards and the city council. Really appreciate everybody taking their time away from their Friday morning to join us. Happy to, well, first perhaps we should start with roll and then I'll pass it on to Chair Jay Castellano and Chair Andrew Gardenier. And forgive me, Andrew, I think I just mispronounced your name. So you're
that
correct.
was perfect.
Oh, good. Great. So why don't we start with the roll?
Jimenez,
Present.
Perales,
Here.
Dieppe,
Present.
Carrasco, Davis,
Here.
Esparza,
Here.
Arenas, Foley,
Here.
Camus,
Here.
Jones,
Present.
Liccardo.
Present.
Thank you.
Thank you. Jay, would you like to start with your board?
Yes. Sorry, it's, I'm sorry, Mayor, would you like me to just do the roll call for them?
Or whoever, yeah, whoever might be calling roll for you. Or...
Okay, yeah, I think I'll be doing that.
Okay, great.
Vice Chair Anurag Chandra. Here, Trustee Horowitz.
Present.
Thank you. Trustee Kelleher. Okay, Trustee Orr.
Present.
Thank you. Trustee Jennings.
Present.
And Trustee Sun.
Here.
Okay, I believe that's all of ours.
Thank you. And thanks to everyone for joining us. And Andrew, welcome.
Thank you, Mayor. So myself, Trustee Gardner is present. Trustee Lanza.
Mayor Andrew.
Trustee Ganapati.
Present. Thank you.
Trustee Lee.
Here.
In stereo.
Trustee Menon.
Present.
Trustee Muyo. Trustee Santos.
Yes.
Trustee Sanzeri. Trustee Votto.
Here.
All right, we got two that are not here present at the moment, but we do have quorum.
We do have quorum. That's great. Thank you. And I invite Jay or Andrew, if you want to make any introductory comments before we jump into the agenda.
Yeah, I'd like to say good morning to Mayor, members of the council, Chair Gardenier, members of the Police and Fire Board, as well as the rest of course, the Federated Board. It's a pleasure to be able to spend the time with you and make the investment in the mind meld and getting all of us on the same page about the status of the plans and vis-a-vis the budget and what the future might hold in terms of the investment portfolio and the downward impacts of all of that. So thank you for the opportunity to be here with all of you.
Thank you, and thanks to you and your board for your service. Andrew, did you?
Yeah, just echo what he said. Thank you, Mayor and City Council, for having this meeting. I believe this is our third meeting now, and I know the last two were very fruitful in conversation, insightful, to the trustees, and so I definitely look forward, and we all look forward to our agenda discussions here. So thank you.
Mayor, if I
Great,
could,
thank you.
One additional note, a little extra thanks to Councilmember Davis. She is such a reliable presence at our meeting, and I know she does a great job transmitting information in both directions between the board and the council and the board. So thank you very much, Councilmember Davis, for doing that for the Federated Board.
Thanks,
Thank you,
Jay.
Jay.
That's really nice.
Okay, wonderful. Well, thank you all. And again, thanks to all the members of the boards. We know you don't do it for the money. You do it because you care about this community, and we appreciate your service. I should also note, and in particular, thanks to the several members of you who have been joining us for the, recently less periodic meetings of our retirement task force to wrestle with steps that we might need to take to address our very large unfunded liabilities and how we can move forward. There have been some very fruitful ideas that have emerged. And just as a simple update, I'd just note that we have filed a memorandum to go to the Rules Committee next week to ask our staff to begin the work to fully analyze and prepare legal documents for pension obligation bonds so that we can all consider our next steps. So we appreciate the work of that committee and we'll certainly continue in November. So we'll begin now with the agenda. The first item on the agenda, the implications of the COVID-19 to the city's budget. Dave and Roberta, thank you both for all your work, and I'll leave it to you to take it away.
Thank you, Mayor. I believe we have a presentation that we'll be jumping into.
That's right. Yep. Am I ready to take it?
Yes,
Okay.
thank you, Jim.
Yeah. Hi, folks. My name is Jim Shannon. I'm the city's budget director. Good to see you all here. We're going to talk a little bit to start off with myself, Julia Cooper, the director of finance, and Nikolai Skarloff, of our deputy director for debt and treasury management, to talk about the implications of COVID-19 to the city's budget. We'll talk a little bit about sort of the impact itself, a little bit about how we resolve or address the shortfall for 2021, and then also talk a little bit about how retirement plays a role in there. And then, as the mayor had mentioned, explore a little bit some potential ways to potentially mitigate what that retirement contribution could be by addressing a portion of the UIL through some pension obligation bonds that Julia and Nikolai will get into. But we'll start off here, get my machine set up. And everybody can see my presentation, I'm assuming?
Yes.
Okay. So again, the COVID-19 impact to the city's budget was immediate. So as soon as we had the shelter-in-place orders hit, we had direct revenue impacts in addition to the indirect economic impacts of the economy at large. And so we'll talk about the different major revenue categories that were impacted. But we had to resolve the budget in sort of a two-step process. So we had a $45 million shortfall for 1920 that we worked with the city council to resolve at the end of April. And then we turned around a few weeks later and resolved the $76.7 million shortfall for 2021. So we definitely had our work cut out for us as an organization to make sure that we were prepared to meet sort of whatever budgetary challenges that the pandemic was going to throw at us, in addition to all the public health challenges that it has. When looking sort of at a broad general fund revenue picture, we had anticipated the COVID-19 impacts to be very severe. So over sort of a 2-year period, we're anticipating a 9% drop in general fund revenues, which is quite a bit larger than what we had experienced in the Great Recession of a little over 5%, and in the dot-com bust of just about 3%. So some very significant impacts that we had to deal with on the revenue side. And which meant we were back into shortfall territory. So this is just a slide, a kind of sobering slide, just to kind of set everybody for where we have been and where we're at again now. So we had the fallout from the dot-com bust, our decade of deficits, punctuated by the Great Recession. In 12-13, we had all the way through 18-19 a lot of stability. We never really, got back, but at least we got to a stable point and were able to sort of strategically add back some resources here and there. But even though 1920 started out with a small surplus, we actually ended up in actually having to resolve that $45 million deficit. And then of course we had in 2021, almost $80 million to solve. So, still back in, really tough budgetary challenges, and we expect these challenges to be equally as difficult for 21-22. Looking at overall, sort of at all funds level, looking at the number of positions that we have across the city, we had our peak in 2001, 2002, which we've never gotten back to that peak, even though our population has grown substantially since then. And then we were growing from 12-13 all the way to 19-20, where in 2021 we again had to reduce our staffing to help address some of the shortfalls caused by COVID. So here is an overview of just looking at the general fund, because that's sort of the largest funding source in the city that can be flexibly spent on any governmental purpose. So that's a lot of what our attention is often focused on. And so here is our $1.5 billion general fund budget for 2021. Here it is broken out by different sources. And so what's good about San Jose is that we have a pretty good variety of general fund revenue. And so that really helps us out to improve a little bit the stability, although we definitely have some impacts here. And my little lightning bolt guys are those categories that we want to kind of focus on in terms of COVID. For sure, sales tax takes an immediate hit. So when we had this cessation or the large, not the cessation, but the significant curtailment of day-to-day economic activity during the peak shelter in place orders, we anticipated pretty significant impact to sales tax because that's day-to-day transactions. Business taxes, so obviously it's going to be more difficult for businesses to do work if they can't sell their goods. And there are some other categories there like parking citation revenue, some fees and charges. Because the city is not operating normally, we're not going to bring in the revenue that we would otherwise bring in. We have anticipated maybe a little bit of a hit to our utility and franchise tax revenues. Generally, they're not in what we call an economically sensitive category. They're more based on what the rates are and what the weather's doing, because we have tax revenues based on how much gas you use or how much electricity that you use. But did anticipate, given the widespread job losses, we were potentially anticipating a little bit of a drop there for some of those tax revenues. For the property tax side, we didn't really anticipate anything for 2021. Most of the property tax proceeds are set by the calendar year preceding. So the 2021 property tax proceeds are pretty much set by what happened in calendar year 2019. So the real question mark for us in 21-22 is going to be how the rest of this calendar year in 2020 turns out. So so far it's looking decent on the real estate side in terms of properties holding values, although transactions are down. And I think the commercial side is still a little bit of a question mark. So it's going to be really critical for us going forward how property tax ends up faring in 21-22, because that is definitely the largest source in the general fund. Another interesting thing about San Jose, for good or worse, we're not necessarily a tourist destination city. And so maybe some of the, because what you don't see in here for others, even though, because it's so small, is our transient occupancy tax or our hotel taxes is only about, about 1% in the general fund. It's quite small, but it took a massive hit because, folks are not traveling and there's very little business travel. But because we're not a sort of a tourist destination, that category in itself wasn't as large as say it would have been for like a San Diego or a San Francisco. Although we do have a lot of special fund activities for our convention center and our cultural facilities and our arts programs that are funded by that TOT tax that are definitely feeling that pinch. So that's a little bit of snapshot of our general fund sources here. And again, the property tax is the one we really want to keep an eye on for 2021 to see how that may change. And so we had a $76.7 million shortfall in the general fund. And we really wanted to be careful about how we address that shortfall. We had a limited amount of time to really get at it. And always our preference and our policy in San Jose is to match our ongoing revenues with our ongoing expenditures to make sure we have a structurally balanced budget. Because this hit us so late in the budget cycle, we couldn't get all the way there, but wanted to do as good a job as we could to do that, because we know that we're actually in, we don't expect to snap the fingers to be snapped as soon as the vaccine's here and we're back to where we were at the beginning of 2019. It's going to be a climb out of here. So we have an ongoing, structural shortfall that we need to address. But what we were able to do is look at all the tools we had available, and we were able to address $40 million of that shortfall with no service impacts to the community. So one of them, we were very fortunate, was recognizing the proceeds of the revenue capture agreement with eBay, which generated additional sales tax revenue to the city that we wouldn't have otherwise had. So that was a really important component. And of course, as folks here know, a really important component was the pre-funding of city retirement contributions, which saved the general fund about $7.4 million, which was, again, a quick action that we all took together to make that happen. We're also very strategic in the leveraging of bond refunding savings to pay down other debt. So finance just recently closed on a refunding of the outstanding debt for City Hall, which generated both some one-time savings and ongoing savings for future debt service payments to the general fund. We repurposed that one-time savings to buy down other debt that was related to our golf courses and to a streetlight LED conversion loan program to pay down that debt to yield additional general fund savings, which is a strategy that the council, which is in a city council policy also, is to take one-time savings from debt refinancing, plow that back in to generate additional ongoing savings for the general fund, which has been really important. And we had some fuel savings along with some other savings here. So by able to use those, try to pull all the levers that we could without impacting city services, we were able to shave off a lot for that shortfall. We had about $11 million of very targeted reductions that did impact some city services. But we also used one-time funding and savings of about $25.7 million. And so about a third of the shortfall or so what ended up being solved with one-time funds, which is appropriate kind of given where we were. But what that means, I'll talk about that a little bit later, is that we still have that problem to solve again then in 21, 22. And so here we have a little bit of a breakdown for that. So we do, those direct COVID-19 impacts in our revenue planning, we had assumed that would, continue at least through 2021. So there's gonna, what we're seeing is that even as opportunities to engage in normal economic activity officially open up, not everybody is going to feel comfortable engaging in that activity. So not only are we sort of directly impacted by the public health orders, but there's also the perception of folks and how safe they feel in doing their purchasing activities. And then we have job losses. And so we're actually operating in a recession. And so, that impact is certainly going to continue throughout this fiscal year, and we're going to keep an eye on that. But we also expect that impact to linger into future years. And again, so because we used about $25.7 million of one-time funding to balance 2021, that was, if nothing else changed, that will be our starting deficit for 21, 2022. But we know things are going to change. We got to update all of our revenue assumptions. We have labor costs, which will go up. We have other costs, which will go up. We have retirement contributions that will likely be higher too. So all of those things, it's very likely that shortfall will be higher than the 25.7 million. And that's the part that we will work to figure out during our forecast development that will be released at the end of February. It's also be interesting to understand how, what the long-term impacts from job losses, how the economy is shifting, how work from home translates into differing amplification impacts from having a technology-heavy sector, and how that is normally a job multiplier effect, but how that may be changing if our day-to-day economic activity and in terms of face-to-face interactions are changing as well. Again, we want to keep an eye on property tax revenues. And we are still experiencing high retirement contributions, and that is, as we know, is going to be forecasted to continue for quite some time. And to think about the expense side a little bit, here is the adopted budget by our general fund uses by CSA. And so it's not surprising that as a city, we spend a lot of our money on public safety. So this is police and fire. Is our largest swath. We've got money in reserves. We have money for strategic support, which is a broad array of different support services like HR, like finance, public works, information technology, city manager's office, council, neighborhood services, which is our parks and libraries, a little bit from transfers. And then we've got some other important CSAs that are either maybe a little bit smaller, like community and economic development, transportation, aviation, environment, and utility services, which don't have a lot of general fund resources, but have a lot of other restricted special funds that power their budget. So this is how we look at our budget from a sort of a city service area. But if we drill into a little bit to see the different types of expenses, we can see that by and large, we are a service organization. So we are spending most of our money on personal services. So this is all of our salaries and our retirement contributions, makes up the bulk of what we spend our money on in the general fund. And then if we look at that from a retirement perspective, we can see, how the impact, because we spend so much of our money on personal services, on labor-related costs, as those labor-related costs go up, especially here we see how the contributions for retirement have been as a gross dollar amount in the general fund, which is the blue line, and more importantly, as a percentage of the general fund adopted budget. And so we can see here that, there's been, consistent pressure that accelerated at the end of the aughts and into the 11-12 fiscal years, has moderated out since some of the reforms and the different actions that the city and the retirement boards have taken. And so we've kind of at this level, still, flatter, but still a quite high level of 20% of the general fund at $320 million. So this is obviously one of the important drivers that is something that we think about every budget cycle, and the retirement boards think about as they think about their approaches for what the city's contribution is going to be in any given year. And if we look at the retirement costs a little bit more closely, we kind of break it down here for the tier 1 and tier 2 costs for our normal distributions between police and fire systems and the federated system. And the biggest component of that, as folks know, is the unfunded actuarial liability, or UAL. And so it's $136.7 million in police and fire, $67.5 million. And again, this is our annual contribution. This is not the total UAL. This is just what the city's in the city's budget in the general fund for 2021, for an overall amount of $200 million. So definitely the biggest component of the retirement contributions is the UAL, and something that quite rightly the mayor had engaged the retirement stakeholders working group to figure out, is there a better way for the city or for the boards to think about how we can lower the overall city's general fund obligation for those costs, because it does constrain a lot of what we're able to spend money on, and address what the deficit could be in 21-22. And here it shows a little bit about where, and this is just a snip I just took from the valuation report for 2019. So I apologize for the sort of poor graphics here. But what this shows for both police and fire and for federated is what the actuarial projections are for the UAL itself. And we're in right now, so the highest period of the UAL required payments from the city to the systems. And so, and we're going to continue to be, although it's, everything, assuming everything goes according to plan, this UAL is going to go down in the future. But even according to the plan, it's going to take a while for us to get there. But the dollar amounts, and it will certainly vary depending on what the new valuation report will say for 2020, as well as any discount rate changes that the boards may institute on a going forward basis. So for the next 15 years, the UAL under its current rubric is still going to be a pretty big driver for the general fund. And identifying ways for us to lessen the UAL's impact in the near term would certainly help the city address the lingering effects from COVID, and potentially preserve and restore some services once we get out of the economic impact directly from COVID itself. And so due to that, I'm going to turn it over here to Julia Nicolai to talk about the pension obligation discussion that we had at the Retirement Stakeholder Solutions working group, because it really relates to this idea of how we address the budget on an ongoing basis. Julia?
Okay, thanks, Jim. So if you go to slide 14, just to kind of give a high overview of what we're going to chat about. And this is an abbreviated version of the presentation that we made to the stakeholder group earlier in the week. So the links there to the full presentations that were made. And also Chiron made a presentation as well, so I provided that link. So on the next slide, just as a background, this isn't new territory for the city with respect to having a conversation about pension obligation bonds. Back around 13 years ago, former Mayor Reed formed a budgets task force. The city manager released a report on general fund structural elimination plan that was looking at strategies that we could look to balance the budget and deal with our pension costs at that time. So on the next slide, prior, kind of just as a background in terms of prior kind of looking at pension obligation bonds, is the direction we got was to explore them as a strategy. Look at an annual prepayment of the city's pension obligation was also a strategy it was considered. And so the city did implement that prepayment back in fiscal year 2009 and did that for 10 years through fiscal year 19. As Jim mentioned, we took a little one-year hiatus, but then last year with the changing economics and market conditions and working with the retirement boards, we did once again commence the prepayment of a significant portion of the city's annual contribution. And as Jim mentioned, save some budgetary savings as well. So back in 2010, the mayor's March budget message, asked for staff to do an analysis of the benefits and drawbacks of issuing pension obligation bonds and to report to the city council. So in May of 2010, on the next slide, just kind of summarizing, that report came forward and concluded that it wasn't a viable tool. The stock market conditions weren't right. And even if the council was willing to assume the risk, there's a pretty long lead time with respect to a court validation process. And the report also pointed out that significant caution was necessary related to the market volatility risks and the potential financial losses to the city over the long term. So further exploration needed to happen in the context and looking at comprehensive look at the pension system and cost mitigations, which the council has done over the last decade. And a copy of that report from 2010 is attached to the material packet that you have today. So on the next slide, when we were looking at this in 2009, the funded ratio for the federated plan was just under 71%, and the funded ratio for the police and fire plan was almost 87%. And then looking at the funding ratio on the next slide in 2009, obviously things haven't gotten any better. So the funded ratio for federated is now at 53% and police and fire is at 74%. What's also interesting to note is a significant change in the UAL as a percentage of covered payroll. For federated over that 10-year period, it increased from 226% to 629%. And for police and fire, it increased from 154 to 544. So as that graph that Jim had earlier, you could see it's an increasing sizable portion of the general fund contribution. So with that, I'm going to turn over to Nikolai, and he's going to talk a little bit on the mechanics of pension obligation bonds and how they can be helpful to the city.
Good morning, Mayor, council members, members of the board. Hopefully you can hear me well. On page 21, Julie and I are going to just be discussing what POBs are, how they save money, who's issuing POBs, what are the benefits, what are the risks, and what are the strategies we can use for mitigating those risks. I'd like to turn to 22. Essentially, a pension obligation bond allows us to inject a large asset, namely investments, into our retirement fund by going into the capital markets and issuing taxable municipal bonds to investors who are willing to invest over a long term, up to 30 years, in some rare cases even longer. And in turn, we can use those proceeds to provide a large injection of assets, investments into our retirement system. And the key to that is that we're taking the more fluid, unfunded liability obligation, or more likely a portion of that liability, and replacing it with a fixed annual debt service payment. The unique dynamic of the municipal bond market is that A, investors are willing to invest funds for many years, as I said, up to 30 years. Unlike the corporate market, municipal bonds are typically serialized. So for a 30-year bond, conceptually, we could be issuing 30 different maturities of bonds, each with their own rate, unlike the corporate market where bonds mature in a bullet. What this means is that the rate on municipal bonds is blended by that, and as a result, they tend to have lower rates. And then just in general, interest rates are at unique lows right now. If I could move to the next page. Earlier this month, our debt team closed a $355 million taxable municipal bond for the refinancing of City Hall that Jim just referred to. Those bonds matured in 2039 and had an average life of just over 10 years and carried a rate of only 2.38%. In fact, just yesterday, we closed an approximately $146 million taxable municipal bond for the ICE Center expansion. And those bonds matured further out in 2051, but had an average life of just under 19 years. And the rate for those was 3.31%. So based on those rates, it's easy to see why taxable bonds are being issued more and more to fund pension obligations with assumed discount rates that are 2 times or more those levels. Local government in California is subject to constitutional debt limitations, and that debt requires a vote unless it falls into certain exceptions. And the courts have determined there are exceptions for lease obligations, like the bonds we just completed, and exceptions for revenue bonds, like the revenue bonds we do for the airport or wastewater. POBs were first used in Oakland in 1985, and back then they were tax-exempt bonds, but the 1986 Tax Reform Act ended that. But then in 1994, Sonoma County started a new wave of taxable POBs in California as refinancings of the third type of debt limitation exception. And those are obligations imposed by law. But because those exceptions are much less developed in case law than lease financings or revenue bond financings, each POB since then has been through a judicial validation. So they've been validated through the Code of Civil Procedure. In essence, what each jurisdiction does is sues itself to get the courts to declare that the obligations are validated. And since these suits can be answered on appeal, the market began the process by insisting on a 60-day appeal period that ran its course before the POBs were issued. Subsequent legislation was passed to reduce that appeal period to 30 days. And that validation doesn't obligate us to issue the bonds, but it does require us to go through the process of putting together the bond documents so that they can be reviewed by the court. But the validation merely protects us and protects the validity of the bonds. So if I can turn to page 24. POBs are being issued all across the country. More than half of them have been issued here in California. Over the last 10 years, 6.3 billion here in California. And according to a book on POBs published by one of the city's bond attorney firms, the counties that have done it: Alameda, Contra Costa, Imperial, Los Angeles, Mendocino, Merced, Orange, Sacramento, Sonoma, San Diego, cities of Fresno, Long Beach, Oakland, Pasadena, and Richmond, as well as the state of California. All of those have issued POBs. And as I said earlier, all rates are near historic lows right now. And POBs have tended to come in waves, both based on the legal issues that have been resolved along the way, but more importantly, based on where interest rates are relative to the discount rates assumed on the pension obligations themselves. So some of the cities that have added POBs in just the past 2 years have been Pasadena, Ontario, Riverside, Pomona, San Bernardino, and Larkspur, among others. The most recent one was the city of Azusa. They issued 10-year bonds with a rate of 2.635%. So it's easy to see why those sorts of rates have provided advantages for folks. And this is a chart provided by the state of California's Debt and Investment Advisory Commission. The next page, please. So fundamentally, a POB can replace the assumed rate in determining the unfunded actuarial liability with a fixed rate on the bonds. And as we said, long-term taxable bonds are currently in the low 3% range, which is much lower than the discount rate our pension systems are assuming and most systems assume. And that's probably best seen in a graph on the next page. If we assume a POB rate for 30 years of 3.11%, and remember that rate will be determined by the market, it'll be based on supply and demand and other factors. In fact, right now, there's quite a bit of volatility in the market. But those savings come from replacing a portion of the unfunded liability with an asset, with our investments, and investing those at earnings that we would assume are 6.75%, and assuming that we can achieve rates in excess of the borrowing costs, we will be advantaged. In the end, however, the actual savings will depend on the actual earnings rate, and so we won't know the true savings from doing this until the bonds mature in 30 years. Next page. On page 27, you can see our city's general financial advisor has helped run these numbers to give us a sense of the sensitivity of the savings to different interest rate scenarios. So if we assume we borrow a $250 million POB at the same 3.11%, with the 6.75% earnings rate, we would achieve $6.6 million a year of annual savings, or present value savings of $118 million. And then this chart gives you a sense of what an increase in borrowing costs would do to those savings, and what a change in our discount or earnings rate would do. And with that, I'll turn it back to you, Julia.
Thank you, Nikolai. So in terms of looking at the potential benefits associated with POBs, you know, as was talked about, kind of this initial reduction in the UAL. So as Jim had on his slide where he was showing that in terms of our annual budget costs, you know, in the general fund, we spend $204 million just on the unfunded actuarial liability. So to the extent that that could be reduced with some fixed payment that comes from paying on the bonds, that's where the savings comes into play. So, and then we also have issues of, you know, market timing. Right now, we're in a, as Nikolai mentioned, in a very interesting situation where there's a significant spread between our borrowing costs and the actuarial assumed rate of return in the pension plans. When we looked at this back in 2009-10, that spread was nominal. And so that one of the reasons why it wasn't economical. And then also the time value of money. POBs help accelerate the investment in the funds, which could theoretically compound the earnings and reduce the unfunded liability over time. On the next slide, we list out some of the risk, because there's always a flip side of the coin. So there's obviously investment risk. This is the principal risk. When you put a large infusion of cash into the retirement plan all at one time, we're making the assumption that the pension plans are able to earn a rate greater than our borrowing costs over the life of the bonds. So that's where the math comes into play. And then also market timing, which greatly impacts the long-term economics. So as again, we put a lump sum into the plan, and then that's being invested by the pension systems over time. There's always a risk of overfunding, and what that would mean with respect to being significantly overfunded. That doesn't happen very often, but it obviously is a risk, and what that would mean for pressures in the plan. And then there's credit risk. S&P generally views POB's issuance in an environment of fiscal distress as a mechanism to provide short-term budgetary relief. So this would be an important factor that we would need to consider in our telling the story about why the city is proposing to do pension obligation bonds at this time. And then also it provides a loss of flexibility. While the actuarial assumptions can change over time, the borrowing rates are set for 30 years unless you refinance. And traditionally you see a fair amount of refinancing of municipal debt over the life. So on the next slide, we just have some summary about kind of how can those strategies be used to mitigate some of those risks. Obviously, the first one is to issue less than 100% of the current UAL. And very few, if any, jurisdictions do a full funding of issuing POBs for their entire UAL. So then jurisdictions consider issuing multiple POBs over multiple years, assuming favorable market conditions. So that helps in a form of dollar cost averaging. And then it also helps with the timing of the issuance at key market cycles, kind of during a low equity market cycle and low interest rate environment. And then also mitigating the market and credit risk and ensuring that you have an adequate spread between the borrowing rate and the assumed interest rate. And then avoiding a riskier bond structures such as variable rate debt, and interest rate swaps. And then also to be prepared to issue POBs when the time is right. As we mentioned, we have to go through a validation process for this, and there's a time involved with that. And so as the mayor indicated, he is going to be releasing a memo to direct staff to start to work on this so we can essentially bring the documents to council, proceed with the validation process, and essentially kind of have this tool in the toolbox when the council is ready to proceed with issuing pension obligation bonds. So on the next slide, kind of the conclusion is that we really don't know the full effect of issuing pension obligation bonds until we get to the final tally where we can look at the maturity of the bonds and to see and compare against the actual investment performance and our cost of borrowing, and can do that measurement. So as I mentioned at the end of the presentation is a copy of the report from May 2010. And then I also included the same slides from the presentation earlier this week that has some literature review and links to reports and things if the council and the retirement boards wanted some more information. So with that, that concludes our part of the presentation, and we're available for questions. And I will have to step out at 10 o'clock because I have a prior commitment, but Nikolai will be on to help answer any finance related questions after that.
Great, thank you, Julia. Thank you, Nikolai, and thank you, Jim. So a lot of information has been provided here. Why don't we go to questions? If anyone who would like to ask a question or offer a comment, just raise your little blue hand. I'll be happy to call you in order.
Mayor Ricardo, Dick Santos through the chair. Has our actuarial personnel, have they reviewed this?
Roberto, you want to respond to that, or?
Yes, Mr. Mayor, thank you. No, Trustee Santos, our actuarial firm is just actually attending the meeting this morning, and they had a chance to see a presentation last Tuesday at the Working Solutions Group on POBs, and this is the second time. So other than receiving the presentation, they had not had a chance to review it and make comments to your boards.
Well, thank you. It sounds fascinating. Like anything else, you want your experts, your consultants to review this to give us advice. Looking forward to that. Thank you.
Thank you. Councilman Camus?
Thank you, Mayor. You know, I was a financial advisor for 20 years before I got into City Council. And this is equivalent to what we used to call a margin strategy, where we would borrow money and make investments.
Yeah.
Well, I could tell you that sometimes it works well, and other times it could really kill an investor. I mean, it will increase your risk factor dramatically because the interest payments on the borrowing still have to be made, even if you're losing money on the investments. I could tell you this, that this is a time in the market where I actually have purchased just yesterday puts on the market because I feel that the market has reached a very, very high level. It's at almost 29,000 as of yesterday. That's when I was looking at it. So if we borrow money and invest in stocks, we will be buying at the all-time high, which you know, it could be a slippery slope. And I just caution against this strategy when I used to advise my clients, I would make them sign a form letting them know that they could lose everything. They could lose, I mean, it can work again. It could put us further into that unfunded liability and faster than we are slipping into it. So I just want to caution that. I know it's a really good interest rate environment, and I agree with all the efforts that staff has been making to refinance our bonds and do the absolutely necessary things that we have been doing. My hat's off to staff and the finance team for refinancing our debts, and we should continue to do so because interest rates are still dropping. But I really caution this. I mean, I think it is a if you will go into Vegas using a credit card, and that's the way I feel about it. And I would not support this strategy, quite frankly. It doesn't matter. I just think the market can really move against us, and if it moves against us in a significant way, we will be in worse shape than we currently are.
Councilor Camus, I appreciate your word of caution. Let me just point out, this is not a decision that anyone on the council needs to consider for another 9 to 12 months, I believe, based on the amount of time it would take to get this legal documentation together. And I think I would join you in saying there's no way I'd want to do it in a time of, essentially market highs, which is what we're looking at right now. I know we don't try to time markets, but I would agree with you. This wouldn't be ideal in this moment. The question is, if the other shoe drops, as I think many expect in financial markets over the next year or so, we certainly expect there's going to be a lot of foreclosures, particularly in commercial side, for a lot of property owners that are not getting rent. There's going to be real financial fallout, and that will affect markets as well. And there will be a trough coming. And the question would be, is that a moment when we would still have low interest rates and be in a very different position? But I agree with you. This wouldn't be the time, I believe, to try this. But obviously, I'm not the expert, and we have a lot of time to get more information before we'd have to make any decisions. The real question is, right now for us is just getting the legal process underway so that we can even get to that point. I'm sorry, staff, did you want to respond in any way? No. Okay.
Well, I don't disagree with you, Mayor, that about your assertion. I'm definitely not going to be around to make that decision, quite frankly. But it does affect taxpayers in the end. We may end up being on the hook for poor decisions. And I could tell you that I don't want to take offense to anybody, but the investment boards move like boards. They don't move at the speed of the market. So decisions that are, we could miss the entire market. When I first came onto the board, I don't know, it's maybe my first year in office. I remember we were trying to dump oil stocks because we had a lot of oil in our portfolio. At that time, I told everybody that the oil markets were at their high. I mean, at their absolute low. I mean, we were getting creamed, but we ended up selling the oil portfolios, and it just in time for the oil portfolio, just in time for oil to go up. And so, I want to caution that because it's a slow decisions made by boards move very slowly, and I want to continue to say that because we cannot react to the market as an individual investor could, selling their stock on a day or taking 1 or 2 days to make up their mind. It will take us months to make up our minds on any decisions made by the boards. So we may have anyway. Anyway, I just want to throw that word of caution out there. I have 20 years of experience as a financial advisor and many more years as an investor, and I don't see this as a good idea. Yeah, because I don't think we can move fast enough, and I don't like to take extra risk with the money. I would like us to entertain other ideas. If there's, did anybody bring up any other ideas on ways that we can close the unfunded liability? I mean, is there any other ideas being floated?
Well, the task force is continuing to meet. There are other ideas, but this is not the only one, and certainly this is not one that anyone has endorsed without mitigation or without qualification. I think we're all very wary of the risks.
Yeah. Okay. I just wanted to say my piece. Again, I appreciate the efforts to look at ways to close the unfunded liability, because it's like an anchor on our city, and I appreciate all the efforts. I also appreciate, again, staff has always looked at ways to refinance our bonds to bring down the interest rates. I could tell you that I'm currently looking at refining again, because I only refied about a year ago on one of my properties, and the interest rates have dropped so low that I'm looking at it again. They're around 2.25%, and that's for a taxable home loan. So I think continuing to look at ways that we could refinance, I think would be very rewarding at this point. So anyway, thank you. That's all I had to say.
Thank you. Vice Mayor Jones?
Thank you, Mayor. A couple of questions. First of all, I agree with Councilmember Camus that we should be cautious. We should take our time to evaluate this. There are some risks. But initially, when I first heard about pension obligation bonds, I was actually not supportive. But as time has gone by and looking at how it can be used, how it can be structured, I actually see some of the benefits of that strategy. But we also had a conversation that actually was at the last joint meeting about the use of pension obligation bonds to make the short-term payments to the pension fund that's prohibiting us from being more aggressive in terms of our investment strategy. The conversation was around why can't we achieve at least market averages of around 7%, which is the historical average of the market. And the reason why was because we had to be more conservative because we had these large pension payments that we had to make. And so that's where the conversation came up around using pension obligation bonds to allow us to make those payments and have a more aggressive investment strategy to at least equal the market rate of returns historically. So I guess this question is directed to staff, or it was actually brought up by one of the board members, but can I get a response in terms of that as being one of the benefits or strategies of using pension obligation bonds?
Is your question to fund the current payment obligation as opposed to the unfunded liability?
It was the conversation was around funding the current obligation. And the reason why we didn't have a more aggressive investment strategy is because we had these obligations that we had to make, and we had to have the funds available to make those, to pay those obligations. And so therefore, pension obligation bonds came up as a potential strategy to address that and mitigate our obligations and allow us to have more aggressive investment strategies to at least meet historical market returns.
Yeah, I mean, generally the credit rating analysts are going to look pretty negatively about funding, because that's like funding your annual operating cost, as opposed to funding the UAL is funding a long-term debt obligation. So it's going to be viewed very differently. I know our annual pension payments out of the plan, and Roberto or Parbu can answer this, are very large. I think they're they're bigger than, Roberto, bigger than the annual contribution the city makes. Is that correct? The payment to the retirees?
Yeah, I mean, payment to both retirees is in excess of $400 million. It's between $400 and $500 million a year.
Well, like I said, I was very, when I heard that proposal, I was very intrigued because I thought it would be an opportunity for us to, again, be more aggressive in our investment strategies, at least try to achieve, the market rate of return, the historical rate of return. And I agree with Councilmember Camus that the market is high, and there's a high possibility or probability that the market is going to have a decline in the short term. But again, if you look at historical averages going back 100 years, it's around 7%. And if we're going to dig ourselves out of this hole, we're going to have to at least meet our assumed earnings rate. And we're not structured or designed to do that now. And so we need a strategy. And whether it's pension obligation bonds or some other strategy, we need to come up with a strategy of how we can at least meet the average market returns. So that's the point I wanted to make. And I don't know, staff, if we can do some analysis or investigation on that strategy, but we need to come up with something to address that.
Yeah, I mean, if the council does give, formal direction for the staff to explore pension obligation bonds, there's a whole lot of work we need to do to bring back a very comprehensive sensitivity analysis, stress testing, working with the retirement plans in terms of looking at what happens over time if the actual rate of return over the term of the bonds is X, Y, Z, and really give you some scenarios to provide a comfort level for the council in terms of when you would be ready to kind of hit that trigger with respect to providing direction to issue bonds. But as we mentioned, there's a long validation process that takes. And so I think the mayor's recommendation is for us to start that process so that we can have the tool in the toolbox if the market and the reinvestment market for the retirement plans and the borrowing market for the city are at a time that we're willing to take the risks associated with that and put some mitigating factors in place. So this is just meant to provide kind of as a education background and then send us off to do some really heavy lifting on the analysis side and come back to the council with that, and then also start the process so at least you have the tool ready to go.
Great. Thank you, Julia. Thank you, team. That's all my questions.
Thank you. Chairperson Gardenier.
Thank you, Mayor. This question is probably more directed to Jim in regards to the budget. I'm just trying to get an idea. I know when you guys created the budget back in, you guys started early on, but you start in the heart of COVID when the economy was completely shut down. You guys had a difficult task of trying to project what revenue would be like. Based off of the information you guys had back then, and now where we are in the recovery process, several months later, how close are we in those projections? Are we still, are we better off than we thought? Are we worse off than we thought? I was just wondering if you could speak to something like that. Just trying to think and looking forward when the two boards have to start talking about actuarial numbers and budget and bills that got to be paid. It would just be nice to have that in mind of what the city is forecasting.
Yeah, I'll take a shot at that. I mean, I think the short answer is it's too soon to know yet for 2021. For 1920. We were very close on almost all of those revenue estimates for how we would close out 1920. I think sales tax came in a little bit better than we thought in 1920, which was good by about $8 million. So that was good news. But I think it's too soon to know how sales tax. We actually don't know. So we get sales tax data almost 2 months after the quarter closes. So we don't really know how we did for July, August, and September until November. And so that's really going to tell us how close we're doing in sales tax. I mean, if I I had to guess right now, I still feel good about those estimates. I think they're maybe still a little bit defensive. So hopefully we are okay there in sales tax. When we look at some of the other, our annual report that's going to council on October 20th, which reports on how 1920 ended and makes a number of budget adjustments for the 2021 year. We are taking down some revenue estimates, more of a one-time nature related to business taxes. So our card rooms taxes, we're taking that down by almost 50% because the card rooms just haven't been able to really open up. And so that's a general fund revenue hit of about $8.5 million, offset a little bit by some of our disposal tax that went up. We also are seeing a lot lower parking citation revenue, which is because folks aren't in the downtown area. We've redeployed some of our parking traffic control officers to other duties, so there's some impacts there. But if I look at sort of the bigger, broader revenue categories, I feel that we are okay where we currently are with those projections for sales tax and business taxes, the longer term general business tax, transient occupancy tax. I think it's just really the question mark about property tax for 2022. The data that we see on the single family home side is still pretty strong. Again, not as many transactions, but the median price is still ticking up. That's going to be, there's going to be some information related to commercial properties that we don't quite have yet. So we're going to get our first sneak peek of property tax also in November for 2022. But there's some other things going on the property tax side, kind of unrelated to COVID, that are out there. There's a state will probably change a little bit of the calculation for a portion of the property tax related to ERAF, the Education Revenue Augmentation Fund, which is going to be, we've taken account most of that into our 2021 budget, but it could be a few $1 million down there. There's also a recent court ruling that will likely change the allocation of the property tax related to the successor agency areas, will likely result in a substantial reduction for what the city will receive on an on both kind of looking back for the past few years and on an ongoing basis. And so, we're still looking at that, but there are the COVID issues with the revenues. Then there's a couple other sort of one-off things that are also kind of challenging us here. But from where I sit right at the moment, I feel good about the original estimates that we made back in the spring.
Thank you, Jim. Thank you, Mayor.
Thank you. Councilmember Yep.
Yes, thanks, Mayor. I just had a question about the bonds. Are those things prepackaged, or do we get to kind of select the market segment that we would be investing in terms of the bonds? Or is it more of a passive type thing where the bank just already has a package of investments that we just invest in?
No, this would be a transaction that the city team would put together, would first have to go through the validation process, and then, as was mentioned earlier by the Mayor and Julia, this is designed so that the council can make the decision in the future, once you have the ability to issue the bonds, when to issue the bonds or whether to issue bonds at all.
Okay, thanks. That's helpful. I guess my comment would be I'm supportive of the strategy. I take Councilmember Camus's caution and his many years of experience as an advisor, and I think that has value. But I also think that right now we're in this unprecedented era that I don't know if the rules apply anymore. There is huge stratification happening in our economy, haves and have-nots, and typically that means that we're going to see a lot of closures and a lot of economic downturn, and I think we still will. But on the other hand, and I think in Asia and in Europe, government interest rates are in the negative territory. In the United States, they're really deep. So you have nowhere else to put your money except in equities and stocks to try to beat inflation. So even as we see some like manufacturing industries go down or as expected, other, tech firms, for instance, Zoom and whatnot, will continue for better or worse to grow. So if we can choose the market segment to really where we're investing, I think there's still room to invest, and that's good, I think, because this discussion that we've been having, at least for the time that I've been on council, is that why are we not, as a city, with our pension boards, getting the rate of return in the market? And of course, the answer has always been we have a mature fund and we need the dollars right away. We can't be risky with it. So I see this strategy as kind of opening up a second pot, so we can bear some risk with dollars that don't need to be paid out right away to our pension recipients. So I think that is a plus, and I understand the risk involved in it, but the alternative to just continuing on is we have a mature fund, and our pensioners need that money, and we can't really do anything to dig ourselves out of the hole. So those are my thoughts.
Thank you. Councilmember Brawls?
Yeah, thank you. Can you hear me?
Yes.
Great. So actually, it was really enlightening conversation at the retirement contributions working group that we had this week to kind of hear some of the strategy, but also some of the history behind pension obligation bonds. And I think there was a couple points that I took away that were really important. One of them was the majority of pension obligation bonds have actually succeeded in achieving their goals over the years. There's only been just a small percentage, and this is obviously, it is due to timing, but it's just kind of, I think, eerily bad luck in regards to poor timing of why some of the pension obligation bonds, again, a minority of them, have not performed well. And I don't know if staff wanted to dive a little bit into that. I'm happy to have them do that. But that was one of the points that I wanted to make. And then the other was just the strategy. And I do think this strategy is important to have us prepared to be able to use this as a tool. And so, and I think there's kind of agreement there from the working group that that's a good strategy to take. That doesn't mean, as the mayor pointed out, we're not making any decisions today. We're just kind of preparing ourselves to be in a position, as Councilmember Camus points out, because it does take time for organizations like ours, municipalities, to make these decisions. And this is one of the ways we can help speed that up. And in fact, the other takeaway that I got from the working group meeting was actually how quickly both the pension boards were able to act as this pandemic hit, and in fact mitigate and actually alleviate all of the losses that we were to take, and sort of balance that out, simply because of how our fund has been distributed. And we have had some, I don't recall the grouping of it, but it's cash-like dollars where we can actually move them rather quickly. And we did so, both boards. And so I think there are ways that even as a municipality, as pension boards, that we can move more swiftly. And I think that, this is certainly something that we've seen. Apologize for the noise. This is certainly something that we've seen help other organizations in similar positions as us. And I absolutely approve the strategy. And if staff wanted to reiterate on some of those points, I'd be happy to hear that. Thank you.
Julie, I'm not sure if you're still with us.
Julia did have to drop off.
Okay, great. Feel free to jump in if you like.
Yeah, I think the point of our conversations this week was not to advocate, but to educate about the option. And we would certainly want to come back with further information about the stress analysis, rating implications, and the like, if the council chose to move forward. Thank you, Mayor.
Thank you. I'm sorry, your voice appears to be a little bit faint, but I think we got most of it. I would just emphasize, we got a long way to go before we pull the trigger on this. So we're going to have many more meetings to come on pension obligation bonds, I'm sure. So we have a lot more opportunity for all of us to get educated, because I know I certainly need to learn much more. Trustee Horowitz?
Yes, thank you, Mayor. With respect to market timing, I would just like to point out that the issue is not whether or not the stock market is today or next month at a particularly high level. It's whether or not it will be much higher in 10, 20, and 30 years from now. There are two markets that we need to time. One is the market in interest rates. We want to issue the bonds when interest rates are quite low, but we don't necessarily have to invest all of that money at that same moment. We can step into the market, we can dollar cost average into the market over some time in order to make the spread that we need. And I will just point out that currently, the dividend yield on, let's say, the S&P 500 is about 1.7%. So that's already most of the way towards the 3.3% that we would need just to cover the bond. That's just the dividend yield. That's nothing to do with the capital gains that the stock market may accrue. Now, this is a risky move. It bears much further analysis, but I would not let the fact that the market may seem high today dissuade us from looking in more detail into this option.
Thank you. Trustee Sun?
Thank you, Mayor. This is a Trustee Sun. I noticed in the budget director's presentation, our FY 2021's adopted budget used over 25% of the funding source as a fund balance. I just wonder, with that application, what is the expected funding fund balance will we have at the end of the fiscal year 2021? Is there any analysis on the volatility of contribution that the city can endure for the pension? Thank you.
I think that's for you, Jim.
I think so. Thank you, Mayor. So I think so of the beginning fund balance is sort of the funding that's carried over from the previous year that was either excess revenues or additional expenditure savings that was not anticipated or was not excess revenue or excess expenditures, as well as any unspent reserve funding. So that gets rolled over into the following fiscal year, and then that gets allocated out in the budget. So in the general fund, we don't really have a fund balance budgeted like we do in other special funds, because all that funding gets allocated because we have a sort of very tight rein on what the general fund is spent on. So of that amount that is allocated out, some of that gets reinvested back into reserves like our contingency reserve or our budget stabilization reserve or various earmarked reserves that are out there, but we don't necessarily have a fund balance budgeted just to have sort of sitting there. What we do estimate on an ongoing basis is, we know in any given year we're going to have some level of excess revenue, a combination of excess revenues and or expenditure savings that will generate fund balance at the end of the year. And so as part of our budget balancing strategy, we assume on an ongoing basis, we have at least $23 million of a sort of unspent proceeds at the end of, or unspent money at the end of the year that can be rolled forward in the following year to then be spent. So does that answer your question?
Yes, that's what I know. So it sounds like we're constantly estimating about 23 million fund balance available for the next fiscal year. So my understanding that 23 million, it's not really that much to comparing with the required retirement contribution. I just want to get a understanding of how much volatility the city can tolerate in terms of pension returns and pension contribution. So I think that number gives me some sort of understanding of that.
Right.
Thank you.
Yep.
And Jim, could we go back to that slide that contained I think it was the general fund uses pie chart, if I'm not mistaken. I think that's what Trustee Sun was referring to, right?
Yeah. Yep.
I think it would just be helpful to clarify, because I know that different organizations use different terminology at times. And it may not be bad just to clarify
Yeah. So
what we mean.
So I think so. On the revenue side here, so this $25.3 million, that's the fund balance. That's that excess revenue or expenditure savings and or rolled over reserves that becomes a funding source for 2021. And then that fund balance is part of our overall, that's lumped into our overall revenue pie that then gets split out and allocated in the budget process to the various departments and CSAs and individual uses that are shown in these two charts here. So if we look at this use chart, so this earmark and contingency reserve, so these are monies that are set aside generally for specific purposes, with the exception of maybe the contingency and the budget stabilization reserve, which are sort of our rainy day / emergency funds.
Jim, if I could, I really wanted to focus you on one issue. If we could go back to that slide for just a moment. I'm sorry, I know we're pressed for time, which is, I think that some may look at this slide and believe that what it means is that although these are uses, sources rather, in our general fund, that this would suggest that typically we spend about 75% of our general fund revenue and we got 25% left over because that seems to be the source for this year. And that would be very misleading because in fact, what we end up with is something that is just a few percent, not 25%. Is that fair to say?
True, yes. And what also I really need to mention too, and thank you for the reminder, is this is also a lot of money that is multi-year funding. So it's funds that are rebudgeted from year to year to continue projects and programs that are already in process. And so that is a significant portion. So what shows up technically as unspent in 1920, but is to continue projects in 2021.
Right, so unspent does not mean unencumbered. It's money that's dedicated to something. So we'd have to cut something to use that money in that fund balance to go pay off, for example, a pension payment. Is that right?
Correct.
Okay. Yeah, I just wanted that to be clear to everybody because I know it can be a little unclear from the, and if I could also just point out, this is our general fund, the $1.5 billion or so. We also have $2 billion in other funds that are restricted for particular purposes. That is, for example, the airport, our energy utility, our water treatment plant, et cetera. And those do pay pension and OPEB obligations for those workers, but obviously the general fund carries the great weight of this. So I just want to make sure everyone's sort of clear about what we're looking at and why. Okay, any final questions before we move on? Trustee Jennings?
Yes, sorry. I want to make sure that when Trustee Sun was asking her question, I don't know if it was specifically towards the unfunded liability or towards just the budget for retirement. And so I was a little confused on that. However, I just wanted to reiterate that of the general fund, 58% of the general fund is personal services, and included in that personal services budget is money for retirement. And that is allocated for the retirement costs of the employees that sit in the general fund. So Jim, I believe I understand that correct? Just
correct.
To
Yes.
put that out there. Yes. Okay, so basically it's the unfunded liability that we're looking at because we already basically budget for retirement within that 58% that is personal services.
Yeah, and just to clarify, we always budget the entire retirement contribution for all city funds that is issued by the retirement boards, the city funds every year. So the UAL is a component of that, but we fully fund whatever that contribution amount is.
Great. Any further questions, Trustee Jennings? Okay, we'll move on then to, okay, thank you. Thank you everyone for that presentation. The second item on our agenda relates to the implications of COVID on investments in the plans. And I assume Roberto and Prabhu will take it over here.
Yeah, thank you, Mr. Chair. Mayor, Prabhu is going to take it over. Prabhu, go ahead.
Mayor.
On there.
And good morning to City Council members. I believe Cheryl is driving this presentation. Thank you, Cheryl. And there was a fascinating discussion on pension obligation bonds. For my colleagues on the retirement task force, please bear with me because this is the identical presentation that I made on Tuesday. So I'm going to start, Cheryl, if you will, can we go to slide 3? And I'm going to start with slide 3. We spoke a lot about our pension plans taking a defensive stance. So I've been asked to speak about the impact of COVID on our investment portfolio and the outlook for the portfolio, and I'm happy to do so on behalf of the boards. And we all know that we've been very defensive compared to some of our peers. And why is that, and how does that translate into strategic asset allocation? Now, Julia pointed out that our obligations are about $400 million a year, north of $400 million a year now. In exactly 20 years, by the year 2040, they are estimated to be close to $1 billion. So these liabilities are very real. And so there's this trade-off, and Bill Hallmark at Chiron has often pointed out that we are a very mature plan. And what that means is that we are going to face significant outflows from the plan in the coming years. So our risk consultant, Veris, did a study 3 years ago, polled various stakeholders, and came to the conclusion that the volatility of our plans should be about 12%, not exceeding 12%. So our boards have followed a very deliberate policy of mixing growth assets, as you can see on this page, with low beta assets and some other assets which protect us from inflation. And what do these terms mean? So growth assets are assets that in a growing economy can actually produce real returns. And we often talk about the 7%, which is currently 6.75%, which is our discount rate. And we need to earn on average over the long run, at least 6.75% per discount rate. And for that, we need exposure to growth assets. Now, we also know that we can only take on so much volatility. And so we balance that by investing in low beta assets. And in that low beta bucket, you will see that there's 5% that's allocated to cash equivalents or immunized cash flow. And so over and above the city's contribution, we are a negative cash plan. And what that means is we have to actually pay benefits over and above the city's contribution out of earnings from the plan. And that runs at about 1% of the plan right now. And as I mentioned, it's going to go up significantly 20 years from now. And so we set aside about 5% of our obligations, plan obligations, as cash equivalents. And we also balance the risk of the portfolio by investing in short-term bonds and absolute return strategies. So this was our asset allocation pre-pandemic. Now, of course, none of us expected a pandemic to happen, but we were cognizant of the fact that assets were not cheap, that the markets were somewhat pricey. It was not at 2000 levels, but they were not cheap either. And they were getting more and more expensive, as from between the years 2016 and 2020. Now, of course, you all know the pandemic hit in March. And Cheryl, if you can go to slide 4. And this chart shows how, and it uses the S&P 500 as a proxy for the market's performance. Now, in the last 100 years, we've had 12 bear markets. And a bear market is a market in which there's a 20% decline in the stock market. So in the last 100 years, we've had 12 instances where the markets dropped 20%. But interestingly, this particular stock market drop was the swiftest in history. It only took 12 days for the market it started on February 19th. And in 12 trading days, we actually hit a bear market. And the market kept sliding all the way till March 23rd. Now, the average drawdown of in the last 100 years in those 12 bear markets was 35%. And between February 19th and March 23rd, in a very, very short time period, we actually lost 35%. Now, this was not the great financial crisis of 2008, 2009, where there were some systemic problems in the market. This was induced by a virus. So there wasn't anything fundamentally wrong with the economy. And this actually came from an external source. Now, as I mentioned before, Veris, our risk consultant, had told us that our standard deviation or volatility should not be more than, that's about the risk tolerance. So the boards decided very quickly, and this is an example of the boards moving very, very fast, because as the market was declining, it seemed like the world was coming to an end and nobody knew what was going to happen next. But we took historical data into account. We took valuations into account, and we did realize that this is a once in a generation opportunity to increase our risk levels. So going into the pandemic, our risk level, our volatility was somewhere around 10.5%. And so this was an opportunity to increase our risk, still within the level recommended by our risk consultant at 12%, but at the same time, take advantage of cheaper asset prices. And so in some extraordinary moves that the boards and the investment committees made, we met multiple times from mid-March to March end, we actually increased our exposure to growth assets. Cheryl, if you can go to slide 5 and then briefly, and then to slide 6. So slide 5 shows that the volatility in March was just the same as the volatility. This is the proxy we used is the VIX index, which is a volatility index. You can see in 2008, 2009, it breached the same number as it did, breached 50 as it did in 2020. And if we can go to slide 6, Cheryl. And so what the boards did very quickly was increased its exposure to growth assets. So we had growth exposure of about 60%, depending on the plan, around the 60% mark, and now we went to around the 70% mark. Now, as Council Member Perales pointed out earlier, the funding source for that is we did have a lot of short-term investment grade bonds, and that was, if we can actually, Cheryl, my apologies, if you can go back to slide 3, I just want to point that out. And you can see here on the low beta strategy, we had short-term investment grade bonds, 15%. And what they really mean is, obligations issued primarily by the US government, treasury bills, and really bonds with a maturity of 2 years or less. And Cheryl, if you can kindly go back to slide 6. So we can use that as a funding source because the value of those bonds had not changed. And we could then deploy them to buy growth assets. Now, of course, as the market slid in the first quarter, it lost close to, as I said, 35%. And then we saw a dramatic recovery in the markets, thanks to monetary and fiscal policy. Of course, none of us expected the market to rebound as quickly when we changed our asset allocation, but we did want to take the opportunity of buying into assets in this once in a generation decline in the markets. The result of this is, you can see this on slide 7, that while the markets actually fell 35% in the first quarter, our plans fell about 10.5%. And this is by design. And this goes back to why somebody mentioned earlier, why are we not meeting market returns? And I'm assuming that by market returns, people generally talk about the S&P 500. There's a reason why we actually manage a well-diversified portfolio. And the evidence of that you can see in Q1 returns. Now, in Q2, the markets bounced back dramatically. In fact, I believe it was the highest quarterly return after World War II. And just coinciding with that, we had increased our exposure to equity. And therefore, both plans actually benefited tremendously from that move. And you can see in Q2, Federated was up 11% and Police and Fire was up 9.6%. And our calendar year return through June 30th was slightly negative, but I'll talk about July, August, and September in a minute. And the result of this is that for fiscal year 2019-20, Federated Plan returned 3.6%, Police and Fire returned 3.1%. And you can see our peers in the public plan universe returned 1.3%. So we actually outperformed by peers by almost 2.5%, which translates to almost $150 million gain for the plans as a whole, thanks to the very swift action by our boards. Now, our calendar year return was slightly negative, that is January 1st to June 30th. But if you look at a peer comparison, our federated plan was in the top percentile. It was the number one plan, number one percentile, and police and fire was in the 12th percentile, and both plans for the fiscal year 2019-20 finished in the top 20% of their peers. Now, what does this mean going forward, right? We're certainly not out of the woods yet. The pandemic is still unfolding. We expect a lot of volatility in the markets, especially because we have an election coming up. But from a quant perspective, let's see what impact this increase in risk level can do to the plans. Cheryl, if we can go to the next slide. So this is a scenario analysis. We've done the same on pages 8 and 9, slides 8 and 9 for police and fire and federated. And so we applied shocks to the portfolio given our current exposures. Now, on average, in the long run, we expect equities to outperform bonds in 7 out of 10 years, and that's what history suggests. And as Trustee Horowitz pointed out earlier, we don't know what's going to happen tomorrow or next quarter or even a year from now, but we are managing for the long term. But you can see in all those other scenarios, equity is down 20% if we had another COVID-19 shock, if we have another great financial crisis, emerging markets crash, 9/11, and so on. In all those scenarios, our slightly higher risk now will negatively impact the plans. But it is to be pointed out again, but in the long run, we believe that our risk stance, and again, it is still within the 12% recommended by our risk consultant, should pay off. Cheryl, if we can go to the next slide. And this again shows, it's a similar chart that shows what will happen, shocks to the portfolio for police and fire. And Mr. Mayors and City Council members, I believe that's the last slide. We just have a conclusion slide. So in short, what I would like to say is that we had a defensive stance going into the pandemic. It really helped our pension plans. Our boards moved very, very quickly and aggressively, which also benefited the plans. I think we're in a much better position today than we were several months ago, thanks to the swift action of the boards. And of course, look, it's difficult to time the markets. Mr. Council Member Camus rightly pointed out that there are a lot of risks in the market. It's very difficult to predict what's going to happen tomorrow. But we felt the same thing on July 1st, because on July 1st, we thought that the markets had rebounded so quickly. Should we be taking risk off the table? But in July, August, and September, once again, we had very, very strong performance. In the quarter just ended, our estimates are that between the two plans, we added another somewhere between 5 and 6%. So again, we are positioned for the long term. We did not time the market. We had a chance to increase our risk level and buy growth assets at a cheap price at the end of March, and that's what we did. I'm happy to take any questions.
Okay, thank you. Thank you, Prabhu. Questions from any of the panels? All right, I'll just throw one out. Councilmember Camus.
Prabhu, thank you for the report. Am I on?
Yeah, you're on now.
Okay, great. I want to thank you for the report, and I do want to thank the board for their quick action. But I do want to remind people, we have been telling the board to de-risk, for a long time, and I'm glad. And we were criticizing them for de-risking at one point. They had the foresight to make these investments, and I got to tell you, I did the same thing. But you have to act as well pretty fast to get out when you think the market is going to go down, and you haven't really made the money until you sell. I used to tell people, don't count your your chickens before the eggs hatch, because you bought the stock and it looks good today, but until you take the profit, you haven't made any money. Do you have a strategy for getting out? I'm hearing from some of my friends in the stock market still that they're taking a defensive position, and they actually think that Joe Biden's going to win and taxes are going to get raised and the market's going to drop. Are you going to get defensive towards, the end of the month, or are you going to take any profits off the table? Or what are you doing to realize the gains, if you will?
That's Councilmember Camus. Thank you for asking that question. That is a great question. So firstly, I need to point out, so when we make changes to our asset allocation in the boards, so there's two types of changes we can make. One is called a strategic asset allocation change, and the other is a tactical asset allocation change. And so when we made the shift in March, and I don't want to speak for the boards, and my colleagues on the board, please feel free to jump in. So when we made the changes in March and April, we really viewed it as a strategic asset allocation shift. So we had a certain risk tolerance, and you are right that we did, the plans were de-risked compared to our peers, but we had a once in a generation opportunity to increase that risk. Now, we certainly didn't expect, I'm speaking for myself, that the markets would rebound so quickly, so swiftly. And so when we make the changes to our strategic asset allocation mix, we expect to realize those returns over many months or years. And so, of course, thanks to fiscal and monetary policy stimulus, the markets rebounded quite dramatically. So what you are suggesting now in terms of taking money off the table falls under the category of a tactical asset allocation shift. And typically we've tended not to do that and the main reason is this, for two reasons actually. One is it's very hard to time the market, and many people have tried it without great success. Of course, people occasionally get lucky. The second thing, what I would point out is there's a difference between managing a portfolio for an individual and managing a portfolio for a pension plan. As an individual, we have timeframes that are, often 1 year, 3 years, 5 years, depending on our stage in life and what we have to do. And so it does make sense sometimes to take money off the table and lock in those gains. For a pension plan such as ours, as I mentioned before, we have very real obligations that are due in 20 years, which will be almost $1 billion a year. So it's my hope that the city of San Jose will be around in 100 years. We'll have prosperous pensioners, and we are really managing our portfolios for the long haul. So we're really not trying to time the market here. We are making strategic shifts. But your point is a very good one. The market does appear very pricey. And now this is not a political statement by any means. But the evidence shows, to your point about Joe Biden winning, the evidence shows that the markets have actually performed better in the last 100 years under Democratic administrations. And I don't know why that is so. But we are certainly not trying to time the market. And I would certainly encourage my colleagues on the board to chime in if you want to.
And I wasn't trying to make any political, I was really not trying to make any political points. I just think that there is some nervousness in the market, folks, about increased capital gains taxes and increased corporate taxes that could drive investors away from the market. I want to stress that I'm not trying to make a political statement. I just wanted to see if there's a strategy for, taking some profits off the table is basically what I'm asking.
Yeah. No, thank you for that. But our strategy really is that, once a year, in the end of January, our investment consultant, Makita, actually comes up with capital market assumptions. And those assumptions are 20-year assumptions. And so once again, our strategy right now is to wait and see what those revised assumptions are. But meanwhile, we are taking a very close look at the portfolio constantly. And just as you pointed out, there are certain pockets of the market that are expensive. There are also certain pockets of the market that could be cheap. And so we try to take opportunity. There could be distressed debt, for example, real estate's another asset class that we're closely looking at. So we try to take advantage of those opportunities, and we're really positioned for the long term. And again, if any of my colleagues on the board want to chime in, please do so.
I see Trustee Orr's raised her hand. Trustee Orr?
Sorry, I'm talking to myself. Good morning, everyone. For everyone who I've not met, I sit on the investment committee as well as the board for Federated. And I come to this with a background from BlackRock and Morgan Stanley. So buy side, sell side, as well as foundation money management. And I just wanted to echo a few things that I'm hearing across both the discussion of this portfolio as well as when we talked about pension obligation bonds. And I think one, which is important to keep in mind and nothing that you may not have already heard, is that, we're focused on a particular set of risks. Our business is to take a certain level of risk for a targeted return. And so we're really trying to keep to that. And with, the experience and the capabilities of the staff, as well as our external consultants, I think that we're really trying to color outside the lines. I think that's a fair way to look at things. We've got these pretty big problems. They're complex and require sort of multi-phase solutions rather than a binary this or that. And so I would say that our role really is to look for the least worst options in terms of overall funding. And then with respect to the strategic asset allocation, which is very much the responsibility and ownership by the boards, is that we take that also with deep consideration and thought, and really looking at it from a diversification across asset class, across time. And so some of these decisions, if you look at it at a microcosm in a moment, they look great. You roll the clock forward 10, 20 years, they may not look as great. So I just want to make sure that people keep that broader context in mind as well. Thank you.
Well, thank you for your comments. I also want to thank the board for making time to act quickly. As I mentioned in the past, that wasn't the case in the past, where the boards would have emergency meetings to get out of a certain position or get into a certain position. So I really want to thank the boards for their dedication to moving quickly, because it was not my experience in the 4 years that I sat on the boards. So again, thank you, Prabhu, for your leadership as well. I appreciate your thinking and your strategic advice to the boards.
Thank you, Councilmember Camus.
Thank you, Councilmember. Any other questions or comments? I just had one, and it was a variant of Councilmember Camus's. Let me just offer this scenario and ask Prabhu if it would have changed your view at all. So undoubtedly, you've heard from plenty of folks. I know you read a lot of what experts are saying out there in the market, and lots of different opinions, certainly. And we all agree that market timing is not something a board, well, frankly, it's hard enough for individual investors. I don't know that anyone really does it successfully, let alone for a board that is managing huge assets over a long period of time. But what we know from 2008 is, foreclosure rates reach about 2.5 to 3.5 or 3.75%. And the fallout was essentially a credit freeze. And, as if the economic crisis wasn't bad enough, the financial crisis is what really froze up the economy because nobody could borrow. And, there has been a lot of concern that may happen on the commercial side here. That is that the other shoe has not yet dropped in this recession, namely that now we've got, was it 13 million square feet right now of office to be subleased between Silicon Valley and San Francisco. We've got a lot of apartment owners who have not been receiving rent. There's going to be a lot of foreclosures on the commercial side, multifamily side, one would expect. And that's not something we've seen yet, but the impacts will be a few months out. And we know credit standards are tightening already. And I think there's certain expectation that there is going to be at some point a credit freeze when these foreclosures roll through. And obviously that's going to have severe impacts on the market. So if 6 months, 8 months from now, all this plays its way out and we have a very steep drop, would it have changed your mind about whether or not, hey, maybe we should have held off 6 or 8 months before we decided to push to more aggressive investment strategies? Or would you continue to say, hey, we're playing for the long run.
Yeah, thank you, Mr. Mayor. So look, I think there are some real issues out there with real estate and the coming credit freeze and so on. And just a point about our own portfolios, we do run a well-diversified real estate portfolio, and we are paying particular attention to our exposure in real estate. And luckily, we've actually made some investments in warehouses and so on, which have all benefited as people shop from home. And those properties have actually gone up in value. And so we've actually made some really good investments there. It's hard to predict the future. So I think at any given point in time, as Trustee Orr pointed out, we're very deliberate about our decisions. We can only take into account all those risks out there, and we have to make a calculated decision. If we don't take any risk, we are of course putting our $6 billion under the mattress, and we're not going to earn anything. So we have to take calculated risks in our portfolio, and that's what we've done. And we will continue to monitor the portfolios very closely. And I think we made the right decision. I'm not sure. Now, of course, things could change. I think the story on the pandemic, unfortunately, is not over. And so things could definitely change. Things could get worse, it could get better. The markets are reasonably good discounting mechanisms. Of course, from time to time, they do deviate from fair value. But over the long run, they're reasonably good discounting mechanisms. And we certainly look to the market for clues as well.
Thank you. Trustee Sanzari?
Yeah, I was just going to add on to that response as well. And when we compare the environment that we're dealing with today to previous pandemic, other crises that we've dealt with, the response that we've seen both from a fiscal and monetary perspective is so much more significant. In 2008, 2009, we had a common enemy, the banks and Wall Street. And because of that, there were battles about providing money to help bail things out. This time around, the enemy is the pandemic. And as a result, there's been a rush to provide aid much sooner in a much bigger fashion than ever before. So while I'm not minimizing the threat of the commercial real estate market and what you're talking about, the size of the response is overwhelming. And just to give you some numbers, the Federal Reserve has pumped in over $6 trillion, which is equivalent to approximately 30% of US GDP. In 2008, 2009, it took them about 6 years in total to fund over $3.5 trillion. So they've moved much faster today in much greater size. And then additionally, from a fiscal perspective, the US government has stepped up. And so far, we have the first stimulus plan of over $2 trillion. That's about 12% of GDP. So combine these two sources, or 40% of GDP, has put a huge floor under our economy to help stabilize things. And I believe that's why the market has responded the way it has. And if the crisis continues to unfold, the feeling is that they will continue to spend more money to stabilize the economy and provide the liquidity we need. So I think that that's a different response this time around than what we saw in 2008, 2009.
Thanks, Vince. All right. Any other comments before we move on? All right. Well, thanks, everybody. We'll move on then to the final item, which is discussion retirement consultant diversity.
Mayor, this is Roberto. I'm not looking at the agenda, but I think that item number 2 had a specific questions on funding ratio and potential
I'm sorry.
Contributions.
You had additional presentation. I'm sorry.
There is a presentation from Chiron, and I wouldn't want Bill to suffer and not being able to speak to all of you because he looks so much forward to this valuation presentation.
Forgive me for jumping ahead.
No problem, Mary.
Hi, Bill. Welcome.
Thank you, Mayor. Thank you, council members and trustees.
I hope you can see my screen now. But I was
Yes,
asked,
we can.
Yes.
okay, I was asked to talk about the implications of the pandemic on the funding ratios and the potential future contributions. So before I get to San Jose specific information, I wanted to take a minute to just share what we're seeing across the country right now and how it's affecting public plans to give us kind of a context for San Jose's situation. And much like here, investment returns are not the main issue so far. And that so far may be an important qualifier, but they've been below our expectations, but just by a routine amount. We frequently miss our expectations in a given year by several percentage points. And so this year was no different. The biggest emerging impact that we are concerned about are related to the budget shortfalls and the revenue. And we've seen some actual layoffs and furloughs and discussions of more potential layoffs and furloughs. Some systems have put in what are early retirement incentive programs. Those actually add liability to the pension plan, but they help remove payroll from the government budget. We've seen some salary freezes and reductions, at least under discussion, if not some actual implementation. And we've seen discussion of reduced or deferred contributions to their pension plans. So far, the reduction in contributions that we've seen has been cancellation of some planned supplemental contributions. So like the state of Colorado, for example, has a poorly funded pension plan and they had planned an additional contribution to help its funded status and they canceled that. Also, some systems have dedicated revenue sources. So like New Jersey, all the state lottery revenues are dedicated to their pension system. And so the state lottery revenues dropped and that dropped their contributions. But going forward, that's the most immediate concern we have. We get asked a lot about mortality experience, and I have to say, right now, we don't know. The impact of COVID has been very different on different populations and different geographies. And so we'll have to see how that impacts individual plans. We've also seen some upticks in retirement rates and termination rates with people having to stay at home or particularly in school systems where teachers have been asked to go back to the school system. We've seen some waves of retirements. So we're watching those things to see how that plays out over the next several months. In the Northeast, where they got hit hard, they've actually done some things to improve benefits by adding some COVID-19 presumptions so that they would qualify for duty, disability, or death benefits, which are higher benefits. That's about the only thing we've seen that actually increases benefits. But to look at the impact on of tax revenues and budgets, this chart is something that is monitored by the Center on Budget and Policy Priorities, and it looks at the projected fiscal year 2021 decline in general fund tax revenues compared to pre-COVID projections by state. And I have to point out, some states give a range. So like Massachusetts, they give a very wide range from 9% to 31%. Others have just provided as a single range, a single estimate. But you can see here, there's quite a range in impacts depending on the state. Clearly, the states that are dependent on travel and tourism, Nevada and Hawaii, are taking huge impacts. The other thing that has impacted states are those that rely on oil revenues and other things like that that have declined. California is looking at about a 20% reduction statewide. So this is not just something hitting San Jose. It's something that hits different localities across the country. These are state budget figures, not municipal governments. So each municipal government is hit differently as well. So with that, I wanted to turn to San Jose and start with our 2019 valuation results and just remind people where we were. And these funded, this chart on the left shows the funded percentage, and these are based on the market value of assets. So the police and fire plan was about 72% funded, and the federated plan about 51% funded. The bars are the liability broken out by the group of people. So the blue bar is those who are currently receiving benefits. The gold is those who no longer work for San Jose but are entitled to a future benefit. And the red is just for your active employees. And so you can see for both systems, the vast majority of the liability, about 2/3 of the liability, is for people who no longer work for San Jose. So that's one of the indicators we use in terms of the maturity of the system and how the burdens are placed on the system. The chart on the right shows the contributions for each of the systems. And so the 2019 valuation determined the contributions for fiscal year end 2021. And it breaks it out into different components. I do want to note, these are not going to match what was shown in the budget presentation, because the budget presentation was general fund, and this is the all funds. So this is all contributions to the plan. The city's total for police and fire was about 206 million, and for the federated about 191 million. But it gets broken out into some different components. So the purple bars represent what we call the normal cost, which is benefits earned in that year. It's benefits attributed to the current year. And the gold is the payment on the unfunded liability. The dark gold is the amount just to pay the interest on the unfunded liability. And then the light gold is what's actually reducing the principal of that unfunded liability. So in that 2021 contribution, about 89 million is going just to pay the interest on the police and fire UAL, and 51 or 52 million is reducing the UAL. For federated, the proportion is different, and most of that UAL contribution, about 135 million, is just going to pay the interest, and we're only reducing it by about 14 million based on contributions. Now, we haven't done the 2020 valuation yet, so we've just collected census data and are in the middle of our process. But I wanted to give you an estimated update based on rolling forward the liabilities, just projecting them, assuming all of our assumptions are met, and then looking at the actual market value of assets that's been reported for each plan. And in combination, we have about $9.5 billion in liability and about $5.9 billion in assets. So the unfunded liability we would expect in this valuation is about 3.6 billion. That's about 3.5% higher than it was the prior year. on a funded ratio basis, it only drops the aggregate funded ratio by 0.1%. So that's fairly level. That will generate higher contributions, but relatively minor in the first year. It doesn't reflect any demographic experience, reductions in payroll or increases in retirement or anything like that. So the numbers will likely change once we get all of that information into our system. So looking forward, given the pandemic, Makita was kind enough to give us their projections for some post-pandemic investment return scenarios so that we could look at what might unfold as we go forward, assuming we don't change any assumptions or any methods. And so the first scenario we'll look at is a 15% increase in the US market, and then it kind of returns to a normal level. So over a 5-year period, we would expect an 8.5 to 8.9% return, depending on the plan. The second scenario is a more average level of increase, a 5% increase in the US market. So we'd get about a 6% average return over the period. And then we looked at a 15% decline in the US market, followed by a recovery. And so you get a sharp drop and then an increase in returns. Average return over the period is about 4%. And then if we have that same decline but no recovery, and so then the average return over the period is about 0%. And in the appendix to this presentation are the details by year of the return, if you care to look. This slide looks at what that would do to our unfunded liability. So we start here at our 3.6 billion for the combined unfunded liability. From the 2019 valuation, we had projected over the 5-year period that would reduce to about 2.9 billion. But depending on the scenario here, it could range from 2.4 billion in the optimistic scenario to 4 billion or to 5.2 billion if we have a decline without a recovery. So there's a significant swing here in potential unfunded liability just based on investment returns over the next 5 years. Then if we look at the contributions, we had projected things to increase gradually. We have kind of built-in increases for expected increases in payroll of 2.5 to 3%. So we had expected the contributions to increase over the period to about 450 million by the end of the 5-year period. But the range, depending on the scenario, it could decline to around 420 million, but in the moderately bad scenario, 490, or in the 15% decline up to 550 million. And if we don't get a recovery, over 615 million. That's almost a $200 million a year range in potential contributions, depending on the scenario. And so that's an illustration of the sensitivity to those investment returns over just the next 5 years. The other issue that concerns us looking forward is what we should expect as future investment returns. And one of the things we've talked to the board about every year is that with the decline in interest rates, it's really forced pension plans to either reduce their expected return or increase the risks in their portfolio. And historically, we've done a combination of that. But to illustrate, back in 1995, the yield on the 10-year Treasury was 6.2%. And for Federated, the discount rate was 8.25%. That meant we just had to beat the return on a 10-year Treasury by 2% to hit our expected return. In the 10 years later, the yield on the 10-year Treasury had dropped to 4%, and our discount rate was still the same. And so that meant we had to beat the 10-year Treasury yield by 4.2. The 10 years after that, we dropped the discount rate 125 basis points down to 7%. But the yield on the 10-year Treasury dropped even further. And so we still had to increase the risks in the portfolio. And we've been fairly stable for the last 5 years, but what's happened now is that yield on the 10-year Treasury has dropped again down to 0.7%. And the question is that a temporary drop? Because I've only shown a few years here, and there's definitely volatility in the yield on the 10-year Treasury. Is that a temporary drop due to the pandemic? And as the economy recovers, we'll see it bounce back. Or are we going to be in this low interest rate environment for a longer period? And if we're thinking it's in a longer period, there will be significant pressure to further reduce the discount rate. Now, to give you a perspective on what happens if we reduce the discount rate, this table shows just what would happen if we reran the 2019 valuation at 6.5% or 6.25%. And you can see it would increase our measure of the unfunded liability, going from 3.5 billion to about 3.8 or 4.1 billion, depending on how far the discount rates move. Now, typically, we wouldn't expect the retirement systems to move more than 25 basis points at a time, but over several years, they may choose to move down more than 25 basis points. In terms of contributions, that would affect both the city and members. And so if we recalculated the 2021 contribution at these lower discount rates, it would have increased from about 400 million to 424 million or 450 million, depending on the discount rate. And member contributions would increase 50 to 100 basis points for each of those moves in the discount rate. So given the pandemic, the uncertainty about the future is even, it's even more uncertain than what we usually look at. And the short and long-term impacts to our pension plans are also very uncertain at this point. I've shown the projections, assuming the retirement boards don't make any changes to their policies. I just want to note that they can and do adjust the pension contribution requirements. We have recently done some adjustments to the amortization requirements for the police and fire plan. So those kinds of adjustments are possible, but the boards have to make sure that they are protecting the pension plans when they do that. And the pension plans also recognize that their sustainability depends in no small part on the financial strength of the city, because the plans are relying on the city to be able to pay those additional contributions in the future. So that's it. I'll take any questions. There are additional details for people who want to jump into the numbers in the appendix.
Thank you, Bill. It was some sobering news. Very helpful. Questions, comments from any trustees or council members? I just had one, Bill, which is, can we go back to that slide about the where you really looked at the declining interest-free return and compared it to the expected risk premium? I'm guessing this is the highest risk premium that we would have seen in the fund's history. Is that fair?
The 6% here, yes.
Yeah. So if you were to advise, and I know we're not at a meeting now, the retirement board, so you need preparation, but just imagine in the abstract world, you were to advise a fund today about what they should do. I assume that advice would be, you probably ought to reduce your discount rate.
Well, I think we are meeting with the boards in November to discuss this. And I think because of how rapidly the interest rates have dropped here, the question is going to be more around, do we expect a quick bounce back, or do we expect this to be a sustained low interest rate environment? And to the extent it's sustained, then yes, we would be looking at lowering the discount rate, probably gradually. Recognizing that has an impact on contributions, we may also consider where we can adjustments to the amortization so that we mitigate some of that impact. So it is a balancing item, but I think it is important to get the discount rate to reflect a reasonable expectation about future investment returns, and then figure out how to pay for the liabilities from there.
And I know that this pension obligation bond discussion is not something that is I know that's not in your wheelhouse necessarily, but would it make sense then if we were to think about a strategy of reducing a discount rate in concert with issuing pension obligation bonds, that would be a sensible way to enable us to reduce the risk of the plan while we are taking at least some of the sting out of the contribution rate in the short run? Or would that have no effect?
Well, no, there's definitely a feedback that we would need to model depending on the terms of the pension obligation bond. And certainly, if you're issuing the pension obligation bond based on the savings between the current discount rate and the current market interest rates, that's going to affect your analysis. Personally, I think you would want to focus more on the interest rate on the pension obligation bond and the probability that you can invest those proceeds to earn more than that.
Right.
And keep the discount rate kind of as an independent variable.
Okay, thank you. Councilor Camus?
Well, I think you're heading towards where I was thinking, Mayor, in your line of questioning. Let's say we borrow, let me see if I could dumb it down for myself. Let's say we borrow at a rate of 3% with bonds. And does the bonds that we are borrowing automatically offset the unfunded liabilities so that it could reduce the interest rates that we pay on the unfunded liability? Or does the interest that we're paying for the bonds it is charged on top of the interest on the unfunded liability?
No, they offset, but the boards would have to decide how they are providing the credit for the additional funds. And so if they just followed their current policies for amortization, it would offset at the 6.75% rate. But that really only affects, well, it has a long lingering effect, but each year when you get actual investment returns on those proceeds, that gets pushed into it as well. And ultimately over time, it's the actual returns versus the 3% you're charged on the bonds that is the critical factor.
Yeah, agreed. But in the short run, I see that.
In the short run, you would likely get savings depending on the board's decision on how to
account for it. So it basically it could be used as an accounting gimmick, if you will. But in the end, somebody has to pay for it.
Correct.
Okay. All right. Thank you.
Thank you. Trustee Lanza.
Yes, thank you, Mr. Mayor. For those of you that haven't met me, I'm the Vice Chairman of the Police and Fire Board. Like Vince, been on there a long time. So let me tell you sort of what I think, Mr. Mayor, about your question, going back to when we said it last year. And I think your question is, geez, can you tell me when this free fall is going to stop? and I think we may be stopped now. 6.75 might be the right number. And the reason why I say that is because when we talk to so we set the risk, and you've helped us, the city, to understand risk in this great big panoply. We look at other plans, we look at the markets, we look at you representing the city. So I think we've dialed in the right level of risk. And when we build a portfolio around that and ask our consultants, Ferris, Makita, and look at other high-end consultants, and ask 50-50, what number are we going to hit? It's around 6.75%, which that sounds right. So we've dialed in the risk. They tell us it's possible. They think that's what we'll get. And I think, Mr. Mayor, you kind of hit on it, which is, I think the consultants are saying 10-year treasuries can't stay below 1%, right? There has to be some recovery to historic. But that's just me. I'm just one trustee, Mr. Mayor. That's my recollection of all the discussions we had last year about setting that number.
Thank you, Joe. All right. Other comments or questions? All right, well, thanks, Bill, for the presentation. Really helpful.
Thank you.
Great. So, Roberta, do you have other items on this agenda item?
No, I do not. No, Mr. Mayor, thank you.
Okay, so then we should probably move to the final item. Yes. I think that's the diversity of management consultants.
Yes, thank you, Mr. Mayor. So let me kick off that one. So first, we want to thank you, the City Council, for raising this very important topic, especially these times. Obviously, as we can see, certainly diversity and inclusion are very critical topics. And as a result of that, we reach out to our consultants. I certainly hope that you all have had the chance to go over the information that we have provided to all of you as a result of the request. But I do also want to make an important note, and is that in the normal course of business, the boards and staff, we don't typically request this type of information from our consultants. In fact, when we are looking at the search for consultants, we have typically focused on the technical expertise needed for the particular job at hand. But that said, again, we recognize these are very different times, and certainly diversity and inclusion are very important topics, and we certainly look forward to an open dialogue with the council this morning on this topic.
Thank you. All right. Any comments from trustees or council members or questions? Vice Mayor?
Yes, thank you, Mayor, and thank you, Roberto. I did raise this question because we have a very diverse workforce, and I felt it was important, and I know that my council colleagues also feel that it's important to have consultants and advisors who are reflective and represent the makeup of our employment base, as well as our residents and citizens. I know firsthand that there's a lot of qualified women and minorities that are out there who, again, are very qualified to do this type of work and advise the boards on investment strategies. Historically, the financial industry has been very challenging for women and minorities to get into, to work in. And I wanted to make sure that it's very clear to both the consultants and the board and the city that we are committed to seeing that who individuals and companies that provide services to us are reflective of our community. And so that's the reason why I wanted to bring up this topic. And looking at some of the presentations of the various consultants like Makita and Reed Smith, I see that they do have diversity and inclusion efforts. I'd like to see all of our advisors and companies that we work with have a robust diversity and inclusion efforts, and would constantly want to see efforts to diversify the staffing, particularly the staffing that works on city consulting projects. So I just wanted to just put that out there, Mayor, in terms of what I wanted to see. And I want to thank Roberto and also the firms for providing us with that information. I also want to see a more robust effort in terms of bringing in and minority and women-owned businesses to actually provide the consulting and advisory services directly. So that's one of the efforts that I would like to see a stronger focus on. And so that's all I have to say, Mayor, and thank you for allowing us to have this discussion and put this on the agenda.
Thank you, Vice Mayor. Are there questions or observations on this? Okay. I don't see any other little blue hands. So we do have time now for public comment, and several members of the community have raised their hands. So we'll go to open forum now. Mr. Beekman?
Hi, thank you for allowing me to be first today. Thank you for the meeting. I guess to start off, it's become my usual speech that at the time of the protests, there was good negotiation about how the next year of the POA contract can be an open process. And to work towards that, good luck in those efforts. How can that be an open process for the whole community to be involved in? That takes effort and work. Good luck in that. Thank you also to the mayor for his forecast about what to expect in the next few years with foreclosures and the like. There was a very important BTA meeting, an A&F meeting at 12 p.m. yesterday that one of the VTA accountants really well described what he expects for the next year or two. That I very much suggest that people look into and read and listen to. The mayor offered his same ideas yesterday to this subject as well. The accountant had some nice forecasts how to get out of that situation. And I have my own ideas since then from the mayor's, he's offered his very, I guess the term is fair warning. And that from that, we really have to consider the funding practices of the HEROES Act and the CARES Act and ideas like that. We have to very much continue to develop those ideas at the state level and be open to it and respect its ideas and what is possible it can work towards. And we passed, for instance, AB 3088 recently. It is way short of what it is capable of and possible of in terms of housing, and it can give help to both owners and tenants. That sort of cooperative effort is what we really need to look for, and that I hope we'll be looking for, and that openness in the next year that can avoid the situation the mayor is talking about. Thank you.
Thank you. The person with the phone number ending 5140, welcome.
Yeah, if you want to get out of all these problems that you have, start opening up, having the businesses open up, and maybe stop bad mouthing the president of the United States. If he kick you down some federal money, but you know, the more you bad mouth him and have your cutesy pie little tweets about him and everything, you're not going to get any money from the feds. I hope he doesn't give you guys any money. You don't deserve it after how you treated him for the 4 years, even when he wasn't president. And you had San Jose PD stand down in June of 2016. I, as a voter, am never going to forget that. I voted for you, Sam, and you're not going to get my vote again, nor are you going to get my vote, Pam Foley. The way you guys talk about the president and Gladhand and all these Democratic politicians like Gavin Newsom and everybody else, all of you should be ashamed of yourself. Ashamed of yourself. Look at each other and say, hey, how are we going to fix these problems? You're probably not. I'm going to end this with all of you have some potholes to fix.
Thank you. William Houston, welcome.
Yeah, thank you guys. I'm William Houston, founder of Bay Street Capital. We're based in Palo Alto, and we are looking to start supporting the city on the advisory side. We advocate for diverse and emerging fund managers, and as an organization, we manage a portfolio of renewable energy and technology assets. I want to start with a story that I like. The story goes like this. It says, I saw a dog. He spied a cat. He chased the cat, and the cat fled down the street, on the roof, but the cat got away. I asked the dog, hey, why'd you let the cat get away? And he said, I was running for a meal, but the cat was running for his life. And we've been listening a lot today, and I see the dog as the market and the cat as the diverse manager. You know, we've all spoken about how diverse and emerging teams are able to outperform the market over time. I believe the city and Polanyi, his leadership team, they're proof of this phenomenon as we've seen during the presentations, how they've outperformed their peers in this space. For the sake of time, I'll also touch on Kathy Wood. 36% returns over the last 5 years, triple the S&P. Bay Street is minority owned. Our consultants are a diverse team of 4 CFAs, 4 CFPs, 4 MBAs, and a PhD in finance. We've got 58% returns year to date with an investment thesis of investing through the lens of history. Polanyi mentioned, the plan's low beta strategy. So we've got a weighted beta of 1.3, which means we take on 30% more risk, but we're seeing about 9 times the return on market average. And it's not just that we're taking asymmetric risks, because everyone should be doing that. It's we're looking at sectors that are supposed to outperform, just as Lan touched on. We also spoke about the interest rates. It's unique, as we said, so it's forcing people to either accept lower returns or to look for higher risk. And so in my view, the market's not necessarily overpriced as much as these lower risks are representing dominant characteristics for the current environment. And it's putting us in a situation where if you're gonna get alpha, you've got to look for special niches and special investment advisors, right? And a lot of times what we found as diverse firms is it's difficult, even if we're outperforming, to get over 2 hurdles that I'll touch on if I can have 30 more seconds. The first being plans rely on the consultants like Makita to provide fund managers, which are often in internal databases. And those internal databases don't often include diverse managers because they don't hit the criteria that the databases are holding. Additionally, few consultants attend a lot of the events where diverse managers are speaking about a lot of these issues. There were several this week, and none of the consultants that we discussed are on. And the second hurdle is the opportunity to participate through the RFP often has minimum requirements that exclude most diverse firms. So those are 2 things that I think would be helpful to address what we're looking to accomplish by engaging diverse firms that are persistently outperforming, so that you can find these managers that have proven to have skill and that are not just lucky, as we spoke. And to balance Johnny's concern with a bit of optimism around a viable solution for this concern about timing the market, if you're looking to borrow with these pension obligation bonds, there is a prudent approach to investing regardless of if the market's at a high or a low. You can completely remove the risk of market timing by just taking a market neutral strategy where you're not necessarily looking to time the market. You're using that leverage to your advantage to improve the returns over time. I think that's something that Palani is aware of and that he'd be able to speak to at a later date. And so, yeah, thank you guys for the presentation today, and looking forward to learning more.
Thank you. All right, back to the council and the boards. Any final comments before we wrap up? I just want to say thank you. I really appreciate the dialogue, and I've certainly learned a lot today, and I know we've got a lot more, particularly on the city side, to learn as we delve into this question of pension obligation bonds. We look forward to continuing the collaboration with the boards. And again, I just want to express my sincere gratitude to all of our board members for your sacrifice of your time and your talent to support our efforts here at the city. Thank you all. The meeting is adjourned.